Assalamualaikum. Okay, today I will continue with the last section of chapter 3, which is gap. Okay, so gap is another important formation that can be used by the investor or trader to make an analysis of chart performance or to help them to making decisions. Okay. In this chapter or in these sections, I will explain of what is gap and a few types of important gaps. Okay, first gaps. What is gaps? Okay, if you can see, by definition, gaps is the area or the positions of certain pattern to another pattern, there is a blank space. Okay, so in technical analysis, gaps are the situation whereas price chart have a blank space. Okay, this gap represent times where no share are traded within a particular price range. Okay, there are two primary category of gaps. Okay, first we call it as a gap up, and second one is gap down. Okay, what is gap up? Gap up happen when the lower price after the market close must be higher than the previous day high price. Okay, so while a gap down, a higher price after the market close must be lower than the previous day low price. Okay, so normally, for example, I give you example of gap up. When the market open in the morning, we always refer to the previous close price. For example, if the previous close price is 2 ringgit and the next day market open at 2 ringgit 50 cent, then we call that situation as a market open with a gap up. Why? Because of the market is open higher than the previous close. Okay. However, the confirmation of those gap up only will be appear or only confirm when the market close. As I mentioned just now, gap up is wherever the lowest price of that day, the new day. Okay, for example, market just now I said market open at 2 ringgit 50 cent, and at the end of the day market closed at 3 ringgit. So those situation, those particular day, we can confirm or we can consider as a get up. Why? Because the lowest price after the market close is higher than the previous day high price. Okay. So gap usually happen due to the extraordinary buying or selling interest developing while the market close. Okay, gap is an evidence that something important has happened to the fundamental of the company or to the psychology of the crowd that accompanies the market movement. Okay, for example, when the market close, gap ups. Okay, why the price can open higher than the previous close? Whenever the investor thinks that, or the investor believe a company will announce something good tomorrow, or company will announce their financial performance and having a positive or a very good result. So most of the people will try to buy those stocks, okay, in order for them to make sure that they can get the opportunity to buy. What they can do is by offering a higher price. Okay, this situation will lead to a gap up uh, situation. Okay, gap also happen in a negative way situation. For example, if you still remember that I mentioned to you about what happened to the market after 2018 election, or what happened to the market during the COVID-19, and what happened to our Bursa Malaysia when government issue or order this movement control order. So in those days, many stock facing a gap down. Okay, later on I will show you example during the class tutorial. Okay, so the first type of gap that I will discuss today is a common gap. Okay, common gap also referred as a trading gap or an area gap. Okay, this gap happen normally not related to any event. That's why we call it a common gap. So it normally appear in the trading range or congestions area. Okay, and normally it's come with low trading volume. Okay. This is example of a common gap. Okay, this gap is not. I said it's not important. It's important, but maybe the impact is not so much because of it's not been supported by any event. So if the gap happen supported by any event, for example, the fundamental or the economic condition, the political conditions, those gaps are really significant gaps. And as a trader, we need to focus, or we need to take carefully attention to those type of gap. Okay. So furthermore, this type of common gap is not uh, supported by the trading volume, as we know that when any movement without a trading volume, those movement may be not strong as another movement that's supported by the highly trading value. For example, in this common gap, if you can see, what happened here is a gap up. Why I call it a gap up? Because of this is the previous day. And when the market open next day, market open high and close higher. Okay? So in this situation, if this situation is supported by a positive news, positive fundamental position of the company, the volume must be high, and it gives a signal to investor. Okay, this company making something good. Okay, this company having a good opportunity. However, if we can see from this chart, a few days after a gap up, the price decrease again and closing the gap. So that's why I mentioned that it's really important we as investor to measure or to identify if any gap occur. We need to check what happened. Does this gap supported by any fundamental news, any economic news, or any psychological trading? And check also the volume. If everything is complement each other or agreement in each other, so then we can take the opportunity to trade. However, if the gap happen or gap appear but not supported by any news, not supported by any psychological condition, so those gaps are maybe on only a temporary action. Okay, so we need to be careful with that. Okay, the second type of gap is a breakaway gap. So since the name is a breakaway gap, so we know that this gap will appear as a signal that the price is breaking out of a trading range or a congestion area. So what is meaning by that? Okay, for example, in this chart, okay, we can see that this is a downtrend, and after certain times, the chart facing or showing a sideways trend or congestion area. So a few times the price testing a support line, and when the price break the support line, they break as a gap down. Okay, so in these situations, whenever the price blank, or that whenever there is a distance, a significant distance between the previous one to the new one, so we call it as a breakaway gap. In this case, is a gap down. Okay. So normally, breakaway gaps normally occur when the price is breaking out the trading range or congestion area, and this formation of this gap is normally will be supported by a significant volume. Okay, as we can see here, when the price gap down and volume also increase. Okay, this breakaway gap can happen during bullish or bearish. Okay, during bullish, normally it happen when the price break out the resistance line after some period of congestions, and while during the bearish, the price break the support line, as this example. Okay, the point of breakout become a new support if upside breakout, and new resistance if a downside breakout. A signal of new trend will begin, but it may take some time for a strong volume. Okay, if, like I mentioned just now, if this gap not supported by the volume, and then it may be a temporary, or the gap might be easily been closed again. Okay, so this is it's also good if the formation of gap is supported with chart pattern. If the chart pattern appear and breakout gap happen, it's a positive signal of a direction. For example, this is ascending triangle and happen a breakaway gap. So this one is more significant compared to the other breakaway gap without a pattern. Okay, this is another example. Okay, now, the third type of gap is a runaway gap. Okay, runaway gap are best described as gap caused by increased interest in the stock. Okay, runaway gaps to the upside typically represent traders who did not get in during the initial move up, and while waiting for the retracement decided it was not going to happen. Increased buying interest happened all of a sudden, and the price gap above the previous day close. This type of runaway gap represent a near panic state in traders. A good uptrend can have a runaway gap caused by significant news event that cause new interest in the stock. Okay. Similar to the breakaway gaps, runaway gap also can happen in downtrend. Okay, so this is example of runaway gap. So why this happen? Because of some traders or some investors, they are panic, they will miss out the opportunity to make profit, so they try to enter the market by offering higher price and creating a runaway gap. Okay, runaway gap also been called as a measuring gap. Okay, so then a runaway gap also supported by the volume. So this volume show a significance of this runaway gap. Last one is exhaustion gap. So exhaustion gap are those that happen near at the end of a good up or down trend. They are often the first signal of the trend of the move. They are identified as by high volume and large price difference. Okay, so exhaustion gap happen normally near to the top or near to the lows or troughs. Okay, and this exhaustion gap also must be supported by the volume. Okay, so this full example of gap, we have a breakaway gap, measuring gap, exhaustion gap. Okay, so any question regarding gap, you can